Hey friends, Amy Irvine, founder and CEO here at Rooted Planning Group. And we want to thank those of you that suggested that we offer a quick summary every month of what's been going on. So this is the inaugural summary. We hope you enjoy it. I want to start out by talking about the stock market performance. Now, it's been a crazy week, I know, and when we were recording these slides, which was basically a week at this point in time ago, the year-to-date performance was down about 13.8% in the S&P 500. Now, that's probably varied from the time that this is released to the time that it's actually recorded, but gives you some idea of where it's at. One of the things I love to talk about with a lot of folks is with regards to this total return and pullbacks. This chart is showing you based on the S&P 500 every single year dating back to the 1990s, what the biggest drawdown was with any given stock year. Now notice each of the years have a negative performance year. What this is saying to you is that, for example, this particular year, the market was actually down 48% at its worst point, but it closed at 37%. Or if you look at, for example, 2020 is another, or 2022 is another example. Worst was around 23%, but the market actually is only down 13 at this point in time. When I say only, that's still a big number. And 2020 was down 34%, but closed up 18. So every single year has that particular situation happen. And then some years there's bigger recoveries than others based on, where the price started out at. I also like to show that the average market correction lasts, when we look at the actual decline, about 5 months. That's on average. Now that's the S&P 500 since World War II, and then the average recovery is about 4 months. Now there is a time in between that definitely goes up and down. What you're looking at here, it's that solid blue line, actually shows you the averages, and the light blue lines are everything that has happened as a general rule. Also wanted to mention interest rates still are inverted. So you've got a 2-year interest rate that is higher than a 10-year interest rate. And this is why we're keeping things very short in duration, because you're actually able to get a 2-year rate that's better than a 10-year rate. So right now we're keeping our investments on the fixed income side very short in duration. We will continue to do so. We also look at economic activity indices. You'll notice that both the non-manufactured and the manufactured is down, although non-manufactured actually peaked up just a little bit in the month of August. Again, we'll see where that all heads out. And then finally, just wanted to touch base with you to show you where the balanced market, balanced performances are with balanced portfolios, so that when you're thinking about where your portfolio is at, you can kind of indicate, you're not at the top, you're not at the bottom, you're somewhere in the middle. And I always used to like to say, or still do say, good asset allocation means you always have to apologize for something, because you're either not beating the S&P 500 or you're not beating some other index that's out there, but you're also not performing at the lower levels from where the balanced is. We hope you've liked this. If you would like additional information, hop on over to our 10-minute video. I know this was supposed to be 2 minutes, but I just had a little bit more that I wanted to throw in there this time. We hope you've enjoyed.